Hi, in this video, we will discuss in detail the two methods of treatment of reserves, accumulated profits and losses, and the fictitious assets at the time of retirement of partner. Before we begin, we will see why such a treatment is necessary and when each of the methods, method 1 and method 2, is to be used. So why is treatment of reserves and accumulated profits and losses necessary? All the reserves and accumulated profits, losses and fictitious assets were created when all the old partners, including the retiring partner, were managing the firm. Now when a partner retires, if any reserves and accumulated profits or losses exist in the balance sheet, they should be treated so that the retiring partner is not put to any undue advantage or disadvantage. When should each of the two methods, method 1 and method 2, be used? Method 1 is used when the reserves and accumulated profits and losses and the fictitious asset should not appear in the reconstituted balance sheet. And method 2 is used when the reserves, accumulated profits and losses and the fictitious assets should continue to appear in the reconstituted balance sheet. The reconstituted balance sheet is a balance sheet which is prepared after taking into effect the retirement of partner. Let's go back into detail on when to follow method 1. We know that method 1 is to be followed when nothing is mentioned or the question says reserves and accumulated profits are to be distributed and fictitious assets and accumulated losses are to be written off, or if the question says that reserves, accumulated profits and losses and the fictitious assets should not appear in the reconstituted balance sheet. So these are the three instances when we know we have to follow the first method. When do we follow method 2? We know that method 2 is to be followed when question says reserves and accumulated profits and losses and the fictitious assets are to be adjusted through partners' capital or current accounts, or if the question says that reserves, accumulated profits and losses and the fictitious assets should continue to appear in the reconstituted balance sheet. So we know that we have to use method 2 in these two instances. So now that we've learnt when to use method 1 and when to use method 2, let's see in detail the treatment under each of these methods. We'll begin with the method 1. All the reserves and accumulated profits that appear in the liability side of the balance sheet has to be distributed among all the partners in their old profit sharing ratio. So the journal entry for distributing reserves and P&L balance, the liability side items, we need to debit the general reserve. We'll debit the P&L balance appearing in the liability side of the balance sheet and credit this total to all the partners' capital or current accounts in their old profit sharing ratio. In case of fluctuating capital method, we'll credit to partners' capital account, and in the case of fixed capital method, we'll credit to the partners' current account. The accumulated losses and fictitious assets that appear in the asset side of the balance sheet has to be written off amongst all the partners in old profit sharing ratio. So the journal entry for writing off the P&L balance and fictitious asset appearing in the asset side of the balance sheet is all the partners' capital or current accounts will be debited and we will credit the P&L balance appearing in the asset side of the balance sheet, and also credit any other deferred revenue expenditures such as advertisement suspense. The total of these will be debited to all the partners' capital or current accounts in their old profit sharing ratio. Narration being the P&L balance and the advertisement suspense written off amongst all the partners in old profit sharing ratio. So these are the two separate journal entries, one for the liability side items and the second one for the asset side items. Next, let's see the treatment under the second method. Under method 2, the first step is to ascertain if the net effect of all the items, both in the liability side and the asset side, is positive or negative. For this, we can use the formulae net effect is equal to, we will add up the free reserves appearing in the liability side, also any P&L balance appearing in the liability side. We'll deduct the P&L balance appearing in the asset side and also deduct any advertisement suspense. So we get the net effect. In case the net effect is a positive figure, the following journal entry will be passed. We will debit the gaining partner's capital or current accounts and credit the retiring partner or any other existing partner who sacrifices his capital or current account. And the amount to be debited or credited to the partner's capital or current account is equal to the amount of the net effect multiplied by the share of gain or sacrifice. Whereas if the net effect is a negative figure, we will reverse the entry and debit the retiring partner or any other sacrificing partner's capital or current account and credit the gaining partner's capital or current account. Narration being adjustment for reserves, P&L and advertisement suspense made through partner's capital or current accounts. The amount to be debited or credited to the partner's capital or current account is equal to the amount of the net effect multiplied by the share of gain or sacrifice of that partner. So in this video, we saw why treatment of reserves and accumulated profits and losses is necessary at the time of retirement of partner, that there are two methods, also when to use method 1 and when to use method 2, and detailed treatment under both the methods. In the upcoming video, we will solve example sums to help us understand the concept of both these methods better.